Biden wants to shut down the credit bureaus, and what would that do, or what would that mean for you? Now, of course, this article is brought to you by Yahoo Finance, so I'll read it pretty much verbatim and then kind of get my interpretation of it just from an angle of how you can prep or plan or know at least what may be coming down the pipeline, because it is just in a proposal state, meaning nothing is set in stone just yet, but you can see little signs of things that are being implemented, that if you just get an understanding of what may happen, you can at least position yourself to benefit regardless, because things are subject to change. That's what you got to understand in life. That's what you got to understand on your journey to building wealth, credit, things of that nature. Things are subject to change. So a lot of times you got to strike while the iron is hot. In other words, when you understand something, capitalize on it, because it is subject to change. And I'm speaking for myself. There's certain things that I may have expected to remain the same, and if I didn't maximize that opportunity, then I didn't benefit from it during the time I thoroughly understood it, and when it changed, it was too late. Now I have to relearn something new. So I've been bitten by that, and I want to help you if you're able to find out about something sooner than later. So with that being said, let's dive straight in. What up, you got Mr. Smith, point 5 of Mr. and Mrs. Smith, and in this brief video, I'm going to go through the article that was brought to you by Yahoo Finance on Biden wanting to shut down the 3 credit bureaus and what that means for you. So let's go ahead and dive in. Let's go ahead and read it, shall we? All right, one of the more fascinating platform items of the Biden presidential campaign was the idea of transferring consumer credit ratings from Equifax, Experian, and TransUnion to public registry under the Consumer Financial Protection Bureau. Now, the Consumer Financial Protection Bureau is an entity that does protect us. I own a credit restoration company, so I'm able to restore people's credit or help them understand how to restore their credit. And it's because of some of the things that the Consumer Financial Protection Bureau has in place that allows us to dispute certain things. So taking it away from them isn't necessarily a good thing. I know the verbiage in this may sound like it's 100% good, but either way, you still have to figure out what changes have been made and pivot or adjust as need be. All right, let's go. As reported by The Balance, this idea was examined in depth in a paper published by a think tank called Demos in 2019. One major takeaway of the paper was that decisions drawing on credit data reproduce and spread existing racial inequality, making it harder to achieve true economic equality. Demos, by demos, I mean Democrats, proposed the idea of a public credit registry in that paper. And I read that article as well. It was just talking about the racial inequality as it relates to credit, how blacks and Hispanics and, supposedly are treated more so unfairly when it comes to credit. And that's without credit, too. Credit is a mask that they may put in front of you to make it seem like that's what is being used, but it's other things that, are done incorrectly. But what I love about blacks and, people who are resilient, all of the barriers you place in front of them, we always thrive and win, which makes us that much more dominant. So what a person might do to be of negative effect to you really makes you stronger and more dominant, whether they know it or not. So it's really not a good strategy, in my opinion. When you're trying to hold a person down, you hurt yourself from a karmatic standpoint, universal standpoint, and a strengthening of the end consumer standpoint. Whole nother conversation, whole nother video. All right. The CFPB has a new acting director. I won't get into that. And basically it said that his 2 main priorities would be relief for the consumers facing hardship due to COVID and related economic crisis, as well as racial equity. But nowhere does his statement specifically mention the idea of a public credit reporting agency. So they're not speaking on having a public credit reporting agency, the CFPB, which is the entity that currently assists with governing what's going on with the 3 bureaus, things of that nature. The 3 primary reporting agencies analyze consumer borrowing and repayment patterns. They assign scores that are then used to assess a person's creditworthiness. This can affect their access to an apartment and their ability to hold certain jobs, in addition to the amount they can borrow and the interest rates that they are charged. It's big business, enough to support 3 public companies, although they have other businesses as well. So basically what they're saying right there is this. It's big business for those three bureaus to have data that determines whether or not a bank can lend you a certain amount of money, how much money, what the interest rate will be, if you qualify for an apartment, if you qualify for a job or a promotion. It's big business for them to hold that data. And in many cases, the data that they may hold, those three bureaus, the data that they may hold may be inaccurate, may be incorrect, may be erroneous, may be in error, which means that if they're in error, you have the ability to remove it. Why? Because of things like the CFPB, the Consumer Bureau, that basically helps to protect the consumer. And there are certain laws in place that help, such as the FCRA, and the Fair Debt Collection Practices Act, certain things in place to help protect the consumer. But it is big business for Experian, TransUnion, and Equifax to keep data that they use and they report, and oftentimes they're getting it from other bureaus as well, and it determines how somebody else can treat you. So you got to understand that it's big business when they're keeping that data, but it's certain entities in place that can help you and help us through the process of getting that erroneous stuff deleted as you go on your credit journey to restoring your credit to where it is, to where you want it to be. All right. While lenders certainly have the right to determine the risk of a potential borrower, the problem is the lack of transparency in the process. The three bureaus have slightly different calculation methods and data sources, which can result in the same person having three very different scores. Some of the criteria seem unusual and can be gamed. For example, it is better to have a high limit credit card and only charge part of it, or only charge part of it, than to charge the same amount on a low limit credit card. Paying off a mortgage can reduce a credit score. All right. In a nutshell, what they just said is, and this is just a matter of being in the know. This is not anything incorrectly that they're doing. It's just knowledge will help change the scenario. So what that means is, based on how the scores are calculated currently, when a person has a credit card, if they have a high limit, meaning, say for instance, they have a $10,000 limit and they spend $1,000 on it, that's only 10% utilization. So it's not as bad as if a person had a $1,000 balance or $1,000 spent on a card that had a $1,000 limit. So the difference is, if you had a $1,000 balance on a $10,000 credit limit card, that's 10% of your utilization. Doesn't look bad. We recommend 10% or less, or really less than 10%. So that's, leaning on the side of heading towards better credit. However, if a person had the same $1,000 spent, but the credit limit on the card was $1,000, that's 100% utilization, which doesn't look good. So that's just basically understanding how it's calculated. And if you know that, then you know how to use that to your advantage. So that's not necessarily a knock on the calculations. If you know it, then you know how to handle it. And that's what we educate on a regular basis, and there's tons of other people who educate teaching those aspects so more people can be informed. That's what we're here to do. But when things change, then we got to, figure out and see how we can empower and help other people as well. Now, as it relates to paying off a mortgage, when you pay off a mortgage, oftentimes it can drop your credit score because, it once was showing up as an active account, but then that account got closed. It's still showing good positive payment history and helping with your credit history, but it can drop your score. It's just how the game goes. But that doesn't mean that if this was to change to the new method, that it won't be detrimental in other areas. So you just got to understand how it currently works and why you have the opportunity. Benefit from all of the previous content that we share. Benefit from the free credit class that we make available in every different video. Benefit from all of those things, so that way you're in position, and if things do change, you're at least on the up and up. And then if you have to make necessary tweaks to your strategy, you can do that, but you're at least in position. So do not take this lightly. Do not take information like this and brush it off, because you never know when you will no longer have the ability to implement what it is that we're sharing that could help you take your score to a higher height. That way, if things do change, you're already in a good place. In addition, errors are commonly but difficult to correct. There's some evidence of racial biases as well, which in turn affect access to housing, certain jobs, and credit. People have the right to free copies of their credit report once a year, but have to pay beyond that. The Biden proposal would improve people's access to their credit and may lead to standardized calculations. It could also lead to volatility if the criteria used change with each presidential administration. There are also other credit bureaus out there that use different scoring criteria, often used by lenders that work with customers who have bad credit. So they're saying that some things can change due to him wanting to take over, and is disguised as making it more transparent. But in all actuality, access to your credit is not that hard to obtain right now. Yeah, you can get the free one, but that's not necessarily the best one to grab anyway. The free annual one, due to the fact that it doesn't typically have the scores, it's just what's on your report. And then when you use that measure to dispute certain things on your credit report, you give them more time to respond. You want to give them as little time as possible so that way you have a heightened chance of getting things deleted. So we recommend using sites like what we make available, as well as myfico.com, which has your more true score as well, that allows you to get a more accurate score, get those scores, dispute directly. Not directly like online, but you can dispute with that and you still have time on your side. So that being said, obtaining scores aren't that hard. I'm not sure what it would transition into, which is why I'm strongly encouraging and advising, or I won't even use the word advise, but strongly encouraging you to consider taking full advantage of the free credit class, as well as anything else that we make available down below, so you can fully take advantage of your scores. Because what's about to happen, or what could potentially happen, is not only will things that you're familiar with be calculated into your credit, things like your streaming service, things like phone bill, cable, all of those things that may not have typically fallen on your credit can start to land on your credit. What does that mean for you? For some cases, that could be great. But for other cases, that can be detrimental if you're late or forget or do certain things that may prevent you from keeping that on your report. If you change services, who's to say that just because you decided to do another streaming platform that won't have an effect on your score? So now you end up finding yourself forced to use these streaming platforms just because you don't want it to mess up your credit. So it's a lot of things that can go into account if that shift was made. It may sound good in some cases, but just be mindful. And also getting the practice or the habit of paying all things on time as it relates to your bills, your expenses, your debts, your loan, because if that switch does happen, they're more than likely going to look back at some of your recent history, your most recent 12 months or 24 months, and see how have you been doing when it comes to paying things that used to didn't count on your credit. So now if they go back and you had any hiccups, guess what? It affects you negatively. So that being said, keep all of these things in perspective. Take full advantage of what you currently have access to, which is information we provide, as well as anything else you've learned along your journey, so you can take full control of your credit and financial situation. And then one day your credit no longer exists, then we have to figure out what pivots we need to make in order to best benefit our personal financial goals and our personal financial situation. That being said, that's all I got. Hopefully you got value. Share this with somebody who you feel may benefit. Mr. Smith, signing out. Salute.